Welcome to tonight's lecture on social entrepreneurship math. And there's a variety of fun numbers and things that we are going to go over. But before we dive in, I want to make a quick plug for the Georgetown Startup Interns program. So if any of you are looking for internships this summer or even next fall or spring semester, we've got a great Georgetown Startup Intern program where you can learn more about opportunities to work at startups or growth stage companies. Most of these are paid internship experiences as well. And I'm also working on a proposal with the university to make it a 3-credit course for next school year. So you'll be able to get credit for the internship as well as some great career experience. So if you see the website down there and go to eship.georgetown.edu/GSI, you can check it out. Let me see if I can bring the chat up here. I will also, before we go to the next one, drop this link here so you all can take a look at it. And there's already a list of companies for this summer that have posted internships in Handshake that you can apply to. And if you have questions about the program or the internships, feel free to reach out to me. I've been working with Jeff Reed and David Lang to develop the GSI program. So we're going to go from GSI to CREAM. Somebody please tell me what CREAM stands for. Feel free to unmute if you know what the acronym here stands for.
Cash rules everything around me.
Get the money, dollar bill, y'all. All right, that is the name of the game as an entrepreneur. Cash is king. All right, and it's super important that you understand that cash is the lifeblood of any entrepreneurial venture, whether it's customers paying you money to generate revenue or raising money from investors, or even figuring out ways to lower your costs so you're not spending as much to produce the products or services, therefore you can make a bigger profit margin. So we're going to go over several different ways that cash flows and kind of supply chain logistics factor into different businesses. I want you to have a foundational understanding of these things, specifically because nobody ever taught me. And I was a math major in college and never once learned what an income statement or a balance sheet was or what cash flow projections meant. It's really good at like abstract algebra and these things that don't actually do anything in the real world. And I spent 3 years running a sunglasses company without understanding how important these different cash flow calculations were, how it could affect the business, especially if it's a seasonal business, as well as understanding when do you need to pay manufacturers to make your product versus when our customer is actually going to pay you for it. You know, that's called your cash conversion cycle. You know, how many days or months is it from when you let go of the money to when you ideally get more money back from a customer. And this picture on the right, by the way, is me at a Wu-Tang Clan concert at South by Southwest a few years ago. It was absolutely epic. Key takeaway, Wu-Tang ain't none to F with. I'll just leave it there. So there are some rules we want to go over. The first is the 80-20 rule. And when you think about your customers, 20% of your customers are going to generate 80% of your revenue. And realize that the other 80% are only actually generating 20% of the revenue. So when you think about how do you want to allocate your time and attention, focusing on that 20% that produces 80% of the value is really important. Now, what's magical about math is you can multiply the fraction by itself and you get the 464 rule, which says that 4% of your customers are going to generate 64% of your revenue. Let that sink in and realize that the kind of Pareto principle, as it's called, is a really powerful thing when you're thinking about building a new company, launching new products, and identifying who are those early adopters and the power users, the folks that are going to love it, are going to want to buy it again and want to tell all their friends about it. The principle also applies to how you allocate your time. And realizing that 20% of your effort probably produces 80% of the valuable output you create, whether that's in schoolwork or working at a job. And so being cognizant that you want to be efficient in how you're allocating scarce resources, whether that's money or time. So the next entrepreneurial math rule is the 40-70 rule. And this is all about the ideal time to make decisions. And it's the percentage of information you have available to you at any given point in time. You will never, in a real life business scenario, have 100% of the information. It's literally impossible. There are variables you don't know. There's things going on with other people. There's lots of things that you're not going to know. And so the goal here is to never make a decision before you have 40% of the information. And it's a little arbitrary here. There's no scale where you're going to weigh the information like, well, I've got 32.8% of the information. You have to use this as a heuristic to realize, hey, if I don't even know half of the information that's going to impact both the decision we make and then the outcome from the work that we do, I need to collect more information. Now, the upper bound here is 70%, and you want to make a decision by the time you have approximately 70% of the information relevant and pertinent to what you're trying to decide on. And with that in mind, you don't want to obsess over every last detail. You also want to think about decisions that can be a two-way door versus a one-way door. And this is a mental model I'll give Jeff Bezos credit for. When he's thinking about decisions, he'll often ask his team at Amazon, is this a two-way door or a one-way door? And what that means is once we go through it, can we go back? If we go through the door and we make this decision, is it feasible that we could actually change our minds and then go back and go through another door? Or a good example of a one-way door is getting a tattoo. When you get a tattoo on your body, that's probably staying there for life. You're not going to change it. But like the color you paint a dresser, you can paint over it. You could paint it a different color. There might be a little bit of pain, extra time, a little bit of extra money to get a new can of paint. But ultimately, that's a decision that isn't going to last a lifetime. And you should also be willing to make two-way door decisions a little bit faster than one-way doors because you're not committing to it. Hey, if we go through door number one, switch to door number two. I'll give you another math trick here. Have you guys ever heard of the show Let's Make a Deal? It's like old school. They'd like have a new car behind one of these three doors, and you pick one of the doors, and then it's like, and they open the third door. Oh, it's not behind this one. And they always ask, do you want to stay with door number one, or do you want to switch? Assuming it's not rigged, and the game show may have been rigged, but assuming it is not rigged, you always want to switch to the other door because door number one from the beginning represents a 33% chance, where everything else is a 67% chance. And when you switch, there's a 67% chance that it's that door because it's not door number three, but that's still in the set that you're choosing. So let that sink in and realize that like it's okay to change your mind and to make decisions without fully committing, knowing that, hey, I want to learn more information. And if we find out, certain variables are true, then hey, we're going to change our decision. The next rule I want to introduce is the 10-80-10 rule. And this deals with project management and delegation. And as a leader, if you are working with other people and you want to enlist their help in working on a project, ideally you want to spend the first 10% with them, scope out what the project is, what needs to get done, and why. When you give people a compelling why we're doing something, they're much more likely to work really hard on it, want to get the desired outcome. You also need to explain what is that desired outcome, what does the end zone or the goal look like. And so you spend this first 10% with them. Then the magic happens. You let them run for the next 80%. You give them the autonomy, the control to work as they want. Maybe you set like a deadline, when it's due, but you're not micromanaging. You're not looking over their shoulder. They may zig where you would have zagged, but if they're going to the same place, you're doing great. And then you want to come back in at the last 10%. And you want to review the work, a little show, tell, check, correct, focusing more on the checking and correcting their work as you've shown and told them what you want them to do. And maybe you got to fix up the formatting or change the font or fix the color scheme a little bit, but most of the work is done here. And what this does is it empowers team members to work hard, to feel ownership over their tasks. Nobody likes being micromanaged. I feel like you don't have that much experience. Well, maybe mom and dad in like high school did some micromanaging for you, but it really sucks in the workplace too. And so understanding the value both if you're the leader delegating the work, as well as if you're the subordinate receiving the work, trying to structure the relationship with your manager in this way that you ask a bunch of questions on the front end, say, hey, all right, let me work on this for a couple of days. I'll bring it back to you, with a list of questions. The corollary to this is called the 20-minute rule. And this is one that I learned from my dad who worked in retail for 50 years. And if somebody if you give somebody an assignment, you want to follow up 20 minutes later to see if they've started it. And if after 20 minutes they haven't started doing whatever the task was, and oftentimes for my dad, this was like setting up a new display of clothes at Sears, or like, figuring out the layout or the planogram in the store. After 20 minutes they haven't started, you gently give them a little kick in the butt and say, hey, let me help you hang up the first clothes here. Let's, make sure you have some activation energy to get started and work on this. In related news, when you get a new project from a boss or somebody like this, get started within the first 15 or 20 minutes. So if they do swing by and say, hey, how's it going? You're not sitting there, still twiddling your thumbs, and have a little bit to show for. The last rule that I want to highlight here is the 1% rule. And this is basically the compound effect. And if you are able to get 1% better every day, and this can be 1% better physically, mentally, emotionally, spiritually, whatever skill you want to get 1% better at, over a course of a year, that compounds massively, where you are actually 37 times better after a year, not 37%, not 370, 37 times better if you get 1% better every day. And so I want you to think about, in skills you want to develop as an entrepreneur, as a student, and whatever path you're heading down, how can you get 1% better every day? What is that minimum acceptable day where, if you want to get stronger, maybe it's doing one push-up. Maybe eventually it's 10 push-ups, but to get started, just do one every day. And once you do one push-up, you're much more likely to do the rest of the set because you're already down there, you've got some momentum. And so thinking about how you can proactively acquire the skills you want to get 1% better. On the right-hand side here, I want to highlight the fact that I got a perfect score on every math standardized test I ever took. I was very, very good at math by all accounts, and I went bankrupt twice. So I say that to share that just because you're good with numbers or not good with numbers doesn't mean you're going to be able to understand how a business operates. It is a unique skill set, and I want to introduce you to a lot of it. And so, simple one question you can ask anytime you need to prioritize, you're not sure what to do next. What is the one thing I can do such that by doing it, everything else becomes easier or unnecessary? It's a great central question to come back to throughout your work, especially as you have competing interests for your time. So now we're going to talk about profit margins. And hint, everything in the green, that relates to cash. In particular, the profits that a business can receive. So in this example, we're looking at wave-borne sunglasses profit margins. And to manufacture the glasses cost about 22 bucks. It's 15 bucks to make the polarized lenses, plus some shipping and handling. And then we're getting into the profit margin here. And what's important to note is that there are different price points that the company could sell this product at. If we sold through our website for a full 250 bucks, that is almost 200, a little bit more than $200 of profit margin, which is an incredible margin. It's a lot of money, and that's great. However, we often sold at the minimum advertised price of 150 bucks. And I highlight the difference between MSRP and MAP here. And I'm sure you're familiar with this when you've gone to stores and you go to the department store and they've got a certain price and then there's a sticker on it and it's 20% off that. And then it's, Labor Day weekend sale, save an extra 40%. They jack up these MSRP prices specifically to give people discounts, to encourage people to purchase because they feel like they're getting a good deal, when it usually costs them 10 to 25% of that MSRP to manufacture the product. And so you also want to think about distribution. And in many cases, Waveborn would actually sell the glasses wholesale to a surf shop that would buy them for $75. And that's kind of the profit wholesale right there, where you get above the 43.23, where we're about doubling our money. And that's called Keystone. We'll get into that in a minute. But realizing that for a product that's listed at $250 as the retail price, I was selling it for $75. And I was telling the stores, hey, you can list it at $250, sell it for $250, great. Not sure you're going to all the time because people hadn't heard of our brand. So you can mark it down $100. You can say 40% off. You can say save $100, or anywhere in that range. You can sell it between the MSRP and the MAP. What's important to note is that the minimum advertised price is a hard line. And the manufacturer wants to be very strict in enforcing that, whether it's with a retail store or with Amazon in particular, that they don't sell it below this minimum advertised price. Because imagine I sold all of you glasses for 75 bucks and I was like, sell them for 250, can't go below 150. Um, and then somebody walks into Liam's store, checks out his website, and he's got them on sale for 99 bucks. And everybody's like, who the heck's this dude? Why are they going to buy glasses from me when they can just Google it and they go straight to Liam's site or they go straight to Amazon and see that they can get it for a lower price? And so you don't want different channel partners to get upset at each other and realistically upset at you. They're less likely to yell at Liam. They're more likely to yell at me. Hey, why is this guy doing it? You got to go, get Big Frank over there and have a conversation with him. Don't worry, Liam. I'm not sending Frankie over your house. You'll be fine. But you do want to be aware of, what are the price points you're selling at. And in different industries, there's very different margins that are kind of normal to be expected. And when I first got into sunglasses, I didn't know anything about this. And at our first trade show we went to, um, we had done a crowdfunding campaign. We'd raised 20 grand. We're like, all right, and we did 10 grand in like a day and a half. We're like, how do we do that more often? And so we're like, oh, let's sell wholesale. And so the glasses were 85, cost us about 40 bucks to make them. I said, well, why don't we sell them for 50? And had never heard of this concept of kind of the different markup stages that we're going to go into here. And we went to this trade show, spent about $25,000 on the booth, on traveling to get people there, marketing materials. I was like, yeah, we're going to make 100 grand. It's going to be awesome. These 3 days, we're going to crush it. We sold 0 pairs of sunglasses. We spent $25,000 and made $0. It was one of the most significant and expensive professional learning experiences I've had. Understanding all the things we did wrong. Part of it was the pricing. And they're like, if it retails for 85, we'll start talking to you at 42.50, which is half off, but we really want to buy it at like 30 or 35 so that we can make an even bigger margin. And we don't really care about your lenses because we're going to pop them out and put prescription lenses because it was like an optical trade show with eye doctors and their offices there. We also learned that our branding was terrible, that our logo was non-discrete, didn't make any sense. We learned that nobody would ever pay for the displays when you put in a shop. Like when you go in a shop and you see like a cool branded end cap at the end of the aisle, and it's like, corrugate cardboard and all that stuff. The company pays for that and has to give it to the stores for free. And so later when we talk about the income statements and how much does it cost to manufacture, this is just for one pair. It's not even factoring in, hey, I might have to spend $100 on a display so they look cool and people want to try them on, and there's a mirror and all of these other things, and print materials and stickers you want to give out. There's a lot of things that go into it. So let's take a look at some of the different shipping, and these are called Incoterms. Basically, who pays for the product when, and who is liable if something bad happens. And you'll often hear FOB as like freight on board, as like the manufacturer will sell to us FOB, so we have to pay for it, from the port of Hong Kong or port of wherever it's made. We have to make sure it goes on a boat or a plane to get to the US. We have to pay for it to clear customs. There's almost always an importing tax in the US when you're importing something. And I'm not going to go down that rabbit hole, but it's expensive and they can hold your stuff and not give it to you, especially if they think it's misclassified. Drayage is like the moving from the importing port. So a lot of things land in LA and then they have to go to wherever the fulfillment center is. Then when you get, let's say you grow big enough where you're not just shipping your product out of your apartment or your parents' basement, but you have a 3PL, which is called a third-party logistics company. That means somebody else is holding the inventory. You get an order through your website. You don't actually touch anything. It sends some electronic information. The warehouse gets it. One of their staff members or potentially one of their robots picks it, puts it in a box, prints out a shipping label, sends it out. When the third-party fulfillment center receives the package, they're going to charge you money to open the box, money to inventory everything that's in there, money to put it on their shelves and into their system. So you're paying not only to ship it there, to get it past customs, but to then get it on the shelves. And then ultimately, you're also going to have to pay your 3PL to pick and pack. So you get an order, they want 3 products, they got to pick 1, 2, 3, you got to put them in a box, print out a shipping label, and they'll charge anywhere from, at one point I was paying 10 cents every time they touched something. God bless you, Alex. And so if you picked a sticker and put it in, that was 10 cents. If you added a cloth, that was 10 cents. If you wanted a hard case, that was 10 cents. If I wanted a handwritten note, that was 50 cents. And this is all just cutting into the profit margin, you know? So understanding the things you need to factor in as you look at some different supply chain models. So the first thing we're talking about is Keystone. This is not a tall, slender 12-ounce beverage that you may have consumed. It is indeed the most important stone in an archway, and it symbolizes the kind of halfway mark of the price. So if the retail price is $100, you're selling at Keystone wholesale, they're going to pay $50, and ideally you're paying $25 to manufacture it. So you double your money, and then the retailer doubles their money as well. And so couple other vocab words we're going to introduce tonight. And remember that investopedia.com is your best friend when there's business words or finance words you don't understand. Look them up. Your COGS stands for your cost of goods sold. So it's how much does it cost to manufacture the product that you're selling. And if you look at your retail price minus your COGS, you get your gross profit. And your net profit will be less because you're going to subtract out some other operating expenses, including payroll and other things that we'll look at a little later. So it's important to understand, you know, gross profit is just the revenue you've got minus your COGS. And so here's an example kind of looking at the margin for, you know, a product that's selling for $196, costs $109 with some change to create. You've got a 44% gross margin. And you're factoring in the drayage, which we went over, to the tax and duty to import it, the freight to import it, the inbound warehouse fee, the warehouse and storage fee. Here's another thing to factor in. Say you get 1,000 widgets and you want to store them in a warehouse. You're going to pay rent every month for those widgets until you have 0 of them left. And even if there's just one on the shelf, you're still paying for shelf space to store this product month over month over month. So you make less and less profit the longer it takes you to sell it because you're paying, you know, in this case, 75 cents, or what is it? There you go. It's 50 cents a month on an average 45-day inventory turn. So an inventory turn is how quickly do you sell through the inventory, turn it over so that they want to reorder. And so these are kind of the 3 different scenarios, especially for e-commerce, selling online. Is the brand shipping it? Do you have a 3PL or is there a retail store? And so if the order is shipped direct to the 3PL, they catch it. Step 2, it's ready to go for fulfillment. Then step 4, you get a customer order, whether it's Magento or Shopify or WooCommerce or Squarespace, you know, one of these kind of e-commerce solutions will then send some sort of message. And there's what's called an API, an application programming interface, that allows your website to talk to the 3PL's system to tell them what to pick and pack. Every product will have a SKU, which is basically like a unique identifier for that product. If you are selling in retail, you're also going to need to get UPC codes. So you know the barcodes that they always scan every product when you check out. You actually have to pay for those. It costs somewhere between $100 to about $750, depending on how many UPCs you want. That's then associated with each product. And so it sends that info to the warehouse. They package up for shipment and they send it out. Alternatively, if you do the shipping yourself, you get the order. You've got the inventory, customer orders. Oh, hold on, sorry. This is when they're buying it at the retailer. So you've got the product all the way to the retailer. They go in, they buy it. When the retailer sells through, they're going to order more from you. And so thinking about the costs associated, this adds up pretty quickly when you've got a shipping fee, the inbound, the per month storage, the pick and pack. There's a credit card processing fee. You're paying 2.9% plus 35 cents or whatever it is. And then the customer acquisition cost is another thing to factor in of how much money did it cost you to market that product or service online? Was it Facebook ads? Were there other things? Did you pay, you know, an influencer to drive traffic to your website? And that has to be factored in too to how much did it cost to actually sell the product. So again, I'm trying to hammer home the point here that any way you're doing business, every step of that supply chain is costing money. So I'm going to look at a case study now for a pair of boots. So they're going to retail for $245, which is looking like a pretty nice margin if it only costs you $54 FOB to get them manufactured in Hong Kong. And you're willing to sell them for $105, which is almost doubling the money to the wholesaler. And so starts in China or Hong Kong. They make the boots, they leave the factory, they put them on a container ship. Ideally, the container ship doesn't go through the Strait of Gibraltar, wherever that place was that the Evergreen boat got stuck. That really messed with some people's logistics and supply chain and cost like billions of dollars. And guess what? As a business owner, you have absolutely no control over what's going on these boats. You just like are praying to God that it makes it to the US, that it gets off the ship, that it then goes to the warehouse, it's received and ready to go. And now layering in some money, you got $2 here, $4 there, 35 cents, another buck, 75 cents, $3, $2. This is all adding up. And remember the wholesale price is 105. So 54 to 105 looks pretty good, but we just added in a lot more costs, which breaks it down closer to 119 instead of 105. So there still is a decent margin if you're selling it direct to the consumer, but if you're selling it to a retail store for 105 or for 120, there's not much margin there. So I'm going to leave this up for a second so you can kind of look at the difference between the brand direct e-commerce model versus the other model and how that factors into how much it's going to cost. And while I'm leaving this up, I want to pause here and see if anybody has any questions about the examples we've talked through and about the different costs associated with doing business and fulfilling physical products. Yeah, Maya.
Just for clarity, these are just like physical products that you would buy. This isn't any sort of like service or like technology. This is just something that you would manufacture.
Yes, like a physical thing people would touch. And that's a great point to highlight, Maya, as well, that if you're selling virtual services or if it's an app, you pay a lot of money to build it once, but then incrementally to serve another 100 people costs maybe a penny, of hosting fees or figuring out, what that costs. It's very inexpensive. And that's often why there are better kind of economies of scale for online services. It's also why everybody and their mom and their cousin wants to create an app these days, because there's like, yeah, just get a bunch of users and then, we'll put ads in it and the ads will pay us all this money. That's not really the best business model and doesn't really work that well until you get, tens of thousands of people using your app. So we want to, in these examples, kind of think about the physical goods supply chain. And obviously the difference here as well in the gross profit, whether you're selling wholesale versus e-commerce, there's a lot more money when you're selling e-commerce than when you add other people in the supply chain. Everybody needs to get a cut. And we touched on this, the kind of manufacturer suggested retail price versus the MAP, minimum advertised price. And so I'm gonna stop sharing for a second. I wanna go over another example in the real world, thinking about hiring like third-party sales reps who can sell your product to other people. So one of my side hustles at the moment is selling these Felix Gray blue light glasses. And as much as, yeah, it'd be great if individuals bought the product, I'm trying to sell hundreds and actually thousands of these to corporate clients. And what we've done is set up an agreement with this ASI organization that has about 20,000 different promo products companies. So think like, actually here's an example. I've got a mug with a logo on it. Like this is a promo product. Anything you can print logos on, well, you can print logos on these glasses. And in order to make it appealing to all of these 20,000 companies, and by the way, it's not 20,000 individual reps, it's 20,000 companies that each have dozens or hundreds of employees, and they have existing corporate clients who potentially are interested in the product. So the frames retail for $95. We offer them a 30% discount to these distributors if they're buying 100 pairs or more. And we say, instead of $95, we'll sell it to you for $66.50. guess what? They're still selling it to their client for 95 bucks, and they might even sell it for more than that, because if they want to print their logo on them, we're going to charge them $5 or $6 and make a little bit of margin there on the printing, but really the money is on the frames and the glasses. And if you're going to order 1,000 or more, we'll give you an even bigger discount. And realizing that part of my role is to incentivize these other people to sell this product to other people, and making sure that we're going to pay them enough money that of all the things that they could be selling, this is a product they want to present to their clients. And so as you think about growing and scaling a company, you need to be thoughtful in the incentive structures that you can build into the supply chain to get people who are, not actually your employees or associated with the organization, who just, what do they care about? They care about making more money themselves and getting a good commission on the order. And so I want you to keep that in mind as you think about what are ways that other people can help distribute products, because ultimately the founding team is not the one who's going to stock all the shelves. And quick poll, have you guys heard of Key2 Super Coffee? You familiar with that? It's started by some Georgetown alums. Oh, should have used this one as a case study here. I will drop a link in the chat here. So it's three brothers, Jimmy, Jake, and Jordan. Jake was a Georgetown alum, I don't know, maybe 3 or 4 years ago. And literally in their dorm rooms, their little brother's dorm room / the house he lived on O Street, right outside the front gates, started brewing coffee in their kitchen. All right. So I'm going to drop a link in the chat here. Check out the website. And originally they were selling it, they were bottling it themselves. They got a little bigger. They're like, all right, we need a co-packing facility for food and beverage to, make a big batch in a vat, put it in these bottles, and then we need to get it on the shelves at stores. They did it themselves. They outsourced it. And when you outsource, you got to pay some of the margin that we talked about. As of today, their company is worth more than $240 million. A-Rod and J-Lo are two of their most recent investors. They went on Shark Tank, did not do a deal, which was perfectly fine, because every display for every store they were in ever since says, as seen on Shark Tank. Okay, that logo is worth millions upon millions of dollars, whether or not anybody actually invests in the company, because you can then say, as seen on Shark Tank. And it started with them stocking the shelves, and then they hired a few sales reps to go stock it. Now they have more than, I think, 10,000 distributors around the country that are distributing this product. It's in, I'm going to say, over 50,000 different stores, most convenience stores, grocery stores, Target, Whole Foods. It's all over the place. And so I share this to highlight, and it probably sells, I don't know, for somewhere between $2.50 to $5, depending on what you're getting. And I'm making the numbers up here, but in my head, it costs, I don't know, 89 cents or so to make it. And then they probably sell it for like $1.35 to a distributor. And then the distributor sells it to a store for like $1.72. And then the store sells it for $2.49, or they sell it for $2.99, and they're allowed to sell it for $2.49 if they want to put it on sale. And it is the magnitude and the volume of units that you're selling and you're moving that dictate the profit and the revenue that's coming into the business and the rate at which you can grow and scale. So something to keep in mind as you are thinking about bringing products to market, and what does that supply chain look like. And so one of the themes tonight is helping you develop some business financial literacy so that you can kind of understand and effectively use some financial skills, including budgeting, knowing how to invest in new products, and having a good relationship with money as well. I don't want anybody to be like terrified of an Excel spreadsheet where they're never going to look at it because they don't know what's going on in there and it's overwhelming. And so we're going to very quickly go into some accounting 101. Quick poll, can you raise your hand if you've ever taken an accounting class? All right, we got 4 or 5 hands in here. So let me share this again. Oops, wrong button. All right, so there are 3 main financial statements. The first and foremost is your income statement, which basically says it's your revenue minus your costs equals your operating profit. Your operating profit minus your EBITDA is your net profit. I was once asked a question about EBITDA, had no idea what it stood for, and gave a response similar to the scene in Billy Madison at the end where he says, you know, everything you have said made no sense and may God have mercy on your soul because we're all dumber for having listened to you. I'm going to teach you what EBITDA stands for now so that you don't make that mistake. It stands for earnings before income, taxes, depreciation, and amortization. That's a lot of fancy accounting terms for saying like the extra stuff you got to pay for, and that like if you buy a laptop this year for $1,000 and it's only good for 3 years, next year its amortization subtracts 33%. So the asset you own is no longer a $1,000 asset; it's a $667 asset because the value went down. Next year it's only worth $333. The year after that, you may be able to still use it, but it's not technically worth anything on your balance sheet. And so the key thing to note with EBITDA is that there's no EBITDA without the E, which is earnings. You got to make money. You got to have revenue coming in to even think about calculating what your EBITDA is. And I don't want to go too far in the weeds there, but the key thing is to note like top line revenue, how much money is coming in the bank from people swiping their credit cards or typing it in online, and then you keep subtracting all the costs. A balance sheet, and by the way, an income statement is something you could have like a monthly income statement. You want to look, you know, pretty consistently, how much money's coming in, what are we spending on different things. Whereas a balance sheet is more like a snapshot in time. It's a photo that primarily you want a balance sheet on 12/31 at the end of every year. And at the end of the year, how many assets do you have? You know, current inventory, accounts receivable that people owe you money, any property, laptops that we were just talking about. And then what are your liabilities? So people that you owe money to, it could be manufacturers, it could be accounts payable. So folks that you need to pay, it could be loans that you have outstanding. Investment that you bring in to your business is actually a liability. And then stockholder equity. So assets equals liabilities plus stockholder equity. Stockholder equity equals assets minus liabilities. And then you also want to think about your cash flow. And of the three, I'm going to say the balance sheet is the least important for you to really dive deep in, but I want you to understand the cash flow. And I want you to understand, what are you spending money on a monthly basis? Are there things that you can delay payment on? And okay, this is the segue to, let me see. Nope. All right, hold on a second. All right. I'm going to spend 5 seconds on this. This is a balance sheet. You got all your assets on the left-hand side. And by the way, all of these templates are available in the Google Drive folder for this class. The slides are in there. There's another presentation on Accounting 101 if you want to look this up in more detail. But it's assets. This number has to equal this number. So ultimately, the assets equals the liabilities and equity. Then you get into your income statement. So top line revenue, this is great. Let's say you're making $852,000. Your cost of goods sold is this number right here. And if you do a little quick, boom, you got about a 35% profit margin there. And that's your gross profit margin because you haven't factored in your people expenses, your sales and marketing expenses, your operations, product delivery, if you're doing some donations along the way. And so if you look at this number and you're just dividing it by top line revenue, it's about a 19, we'll call it 20% net profit margin. And so many times companies, when they're trying to raise money from investors, will build out pro forma. Pro forma just means template, like basic projections of how much money we're going to make over the next several years. This is not a detailed projection because you would want to have some comments about what your assumptions are in different places. And like, why does this number go from 50 to 70 to, you know, who are you hiring? That's a big one people look at. Things to factor in, but ultimately it should make like an up and to the right graph. Now we get into my favorite here. I'm going to zoom in so you can see the cash flows. And so cash flow should be on a month-to-month basis, with cash in being up here and cash out being down here. And this is a case study from a few years ago with the actual cash flow projections I believe we had for wave-borne sunglasses, to think about, how much are we bringing in from sales, and notice that in the winter months, it's basically nothing. And then in the summer months, there's a ton of money coming in. And it's really important that you're aware of the seasonal nature of when is money flowing into the business, because you have all these expenses down here. And so we're talking about manufacturing the products. We're also looking at cases and packaging, retail displays, delivery, the 3PL, sales team training, salaries for just one person, commissions for salespeople, business coaching, marketing, advertising, trade shows, travel, gas, parking, technology, phone bills, your website, meals. All of these things take away from your profit margin. And it's important to design a business that is selling a product at a high enough price that you have baked in margin to be able to afford to cover all of these costs. One of the things that's not in here is health insurance and benefits. That is a really expensive cost. Often, I'll just give you an example. I think I pay about $60 a month now for my health insurance, and my employer pays about $240 a month for my health insurance. So that's really nice of them to pick up 80% of the tab. And if you're the business owner, that means for each employee, you're paying a few $100 a month just to provide them with insurance. And you need to design businesses that can scale, that can meet the growing costs of growth, of growing a team, of providing the team with additional support. Financing activities, there's not a lot down here. This is the real bread and butter of, it's called SG&A. So you're selling general and administrative costs. One thing to note when you raise money from investors, they're always going to ask, what are you going to do with the money? Sales and marketing, great answer. Paying off debt from somebody else, not a great answer. All right. Investors want to invest in the growth of the company. They understand that sales and marketing is a huge part of that. That's how you acquire. It's all of the activities that go into selling. It's printing materials. It's paying for a Zoom membership if you're doing sales demos over the internet. All of these things go into SG&A and ultimately take away from your net profit. And you'll see here on the second tab, I have some assumptions. This is, I'm going to say, a simple way of outlining it. You can make these documents a lot more complex and have formulas baked in where if you change one thing, it propagates through the whole system. I'm not trying to overwhelm you with super complex cash flow projections, but I do want you to think about on a monthly basis how much money is coming in, how much money is coming out. And that money coming in could also be from investments or business loans. There's a variety of different ways to bring money into the business as you go along that journey. So this was a lot. I know I've been talking at you tonight, but my hope is to give you the basic understanding of a lot of math problems that entrepreneurs need to be aware of, because if you start a business, you're not going to start off with like a CFO who knows all of these things ins and out. You're ultimately going to have to make a lot of decisions. And we talked about the 40-70 rule, 40% to 70% of the information. And your cash flow and your cash position, like how much cash do you have in the bank, when is the next check coming in, deeply impacts the decisions you're going to make for your business. There were times during my wave-borne journey where we refused to print any new materials because that was below the line. There's this line of like, what do we definitely have to pay for to keep the lights on? That's a nice to have. We have last year's print materials, and over the winter we had a dip in cash reserves every year. We would have to wait. I remember one year, I think I got on a plane to California with like $8 in my bank account, just straight up $8. I was like, it's going to be fine. And by the time I landed, I got an email from an investor that said she's going to put in, $20,000. And I was like, this is awesome. This was the best plane ever. I just made 20K. And as soon as that check cleared, we went to the printer in California and printed out marketing materials to go to this beach frisbee tournament, MLK weekend. And I hired a couple part-time employees to, walk around the event, to give out the marketing materials, to talk to people about the product, and build that brand awareness. But like, that was the kind of thing that until that money comes in the bank, we can't do that next action to move the sales and marketing efforts forward. I want to pause here and see if anybody has any questions about the topics we've covered tonight, and the different kind of mathematical variables and equations and documents to consider when starting a company. And on the flip side, if there's no questions, I'm going to ask for a few volunteers to just raise your hand or unmute and share what's one thing you learned tonight, one takeaway or new understanding about social entrepreneurship math that you learned tonight. Alex?
I can say I definitely didn't think about how sales work, like in terms of like actual sales, where like it's not just like a company wanting to give like money off. Oftentimes, like you're not really getting quote unquote a discount. They're like just marking down their markup, if that makes sense.
Yeah. Yeah, Nicholas?
I think the biggest thing for me was how much of the prices or costs are like exogenous. So I know when you said the cost of shipping and the freight, it's not like you can be involved in every aspect of the process and sort of just have to make do with certain costs. And that makes me wonder, like, you might have a great idea for a product, but what if the logistics don't work out? So I don't know if that has a huge impact.
Definitely. Can I get one more volunteer for something you learned or took away from tonight's class? Yeah, Deepika?
I was just gonna say, like, to the point that you were just making, how it is super like last minute, like costs could come up that you might not anticipate, and you might only get the funds to be able to cover those costs like the day before. So just being able to be flexible.
Great. And so I just dropped a link in the chat. I'm gonna encourage everybody to check out this Kickstarter campaign started by a Halcyon fellow I've been working with for a few months. They make amazing jeans that are designed for amputees. And if you have two legs that work great, they're gonna fit you perfectly fine. And there's like a little zipper from the ankle to help if you have a prosthetic on. But check out the 2-minute video, super inspirational story. And if you are in the market for a new pair of jeans, feel free to back them. I was delighted to be one of the first folks who backed them on Tuesday. So it's been, we're looking at almost less than 60 hours, and they're almost at 10 grand, trying to get to 12 grand. And I will share too, as I've coached her through setting up this campaign and figuring out her finances, that she needs like $50,000 to manufacture her first run of like 3,000 pairs of jeans in different sizes and colors. And we talked about, how do you want to set a crowdfunding goal? I was like, the goal isn't 50K. Like, you can get that in a few different ways. You want to set a goal that you can reach quickly and have the social proof and momentum where they're over 80% of the way to their goal, and that makes it more appealing than if they were 2% of their way there. And so seeing some social proof is also why Kickstarter is a great way to test the market. And I will also share too that since she's had such big success in the past 48 hours, somebody offered to invest $100,000. That can pay for some production as well. So there are lots of ways to fund a business. And I do think crowdfunding is a great way to go about it, especially if you have a loyal following and an email list of folks that you can market to get them to back it. So thank you everybody for your time and attention this week. We have one more synchronous class next week. And it's just going to be a panel discussion with a few social entrepreneurs I'll share some info next week about them. I'm excited for it. It'll be pretty fun. And the only assignment you've got left is to work on your final book reports, finish reading them, get the 5-minute video with some sort of slides involved in it submitted by May 6th. And yeah, if you have any questions, let me know. It's been a lot of fun this semester, and looking forward to wrapping things up together next week. And we'll also just share, like, I'm available to be a resource for you in perpetuity. Well, after this class ends, and even after you graduate Georgetown, happy to support you along your entrepreneurial and professional journeys, whether that's career advice or connecting you with folks in my network if you want to learn more about some of the startups and growth stage companies. So thanks, everybody. I hope you have a great night, and I will see you next week. Take care.
Thank you.
Thank
Have
you.